In this video, we're going to discuss temporary differences between book income and taxable income. Depreciation frequently creates a temporary difference, and the reason is that for book purposes, a lot of firms use the straight line method of depreciation. But for tax purposes, they're required to use an accelerated form of depreciation. So either way, they're taking the same amount of depreciation over the entire life of the asset, but for tax purposes, they're getting the deductions kind of front loaded. They're taking it more in the early years of the asset's life, and then taking fewer deductions toward the later years of the asset's life. And that's going to create a deferred tax liability that's going to reverse over time. Now, for purposes of recognizing bad debt expense, there's also going to be a temporary difference because for book purposes, firms use the accrual method, and they can actually use a couple different styles of recognizing bad debt. One is the percentage of sales approach, and another is the aging method of accounts receivable, where they look at a percentage of receivables. But they're basically using accrual method, and what I mean by accrual is that they don't wait until the actual bad debt becomes bad, right? So they don't say, oh, I'm going to wait till this customer actually goes bankrupt before I deduct a bad debt expense. But that's what you do for tax purposes. For tax purposes, and we call it the direct write-off method, and that basically means you wait until that customer actually goes bankrupt or whatever, it becomes clear that they are not going to pay, and then you get the tax deduction. So that's going to lead to a temporary difference. Warranty expenses also, it's basically the idea is that for book purposes, you're using accrual accounting. You're saying, hey, we made some sales and we think that there's going to be some warranty expenditures down the road because of these sales. So you accrue a warranty expense, even though you haven't recognized it, or actually for cash purposes, you haven't actually made any warranty expenditures. Now, for tax purposes, it's basically similar to bad debt, where you wait until cash actually changes hands. You wait until, let's say you sell toys, and you have a defective toy, and then you have to make some kind of warranty expenditure, or let's say you have a car, you sell cars, and you have to make some kind of warranty expenditure to repair something faulty in the car. At cash basis, when you pay out the cash for that warranty expenditure, that's when you get the tax deduction. Now with things like prepaid, when we think about prepaid expenses, like for example, if you think about prepaid rent. So for book purposes, for financial reporting, when you have prepaid rent, you capitalize it as an asset, and then you expense it over time as you use up the asset, right? However, with tax purposes, you get the expense as soon as you pay out the cash. So there's no capitalization or worrying about anything like that. Now on the flip side, when you receive revenue in advance, and basically for financial reporting purposes, we would call that unearned revenue. So let's say that you're a landlord and you receive rent in advance, and you haven't earned that rent yet because the month or year hasn't passed or whatever. That's unearned revenue. That's going to be a liability. If you remember, that's going to be a liability. It's going to go on the balance sheet. But for tax purposes, it's taxed upon receipt. That basically means that if you are a landlord and someone gives you rent in advance, now you are going to be taxed on that income even if you technically haven't earned it yet. So if somebody prepays the rent, then you could be taxed immediately. And so so let's say you're a construction firm. So construction firms for book purposes can use the percentage of completion method to recognize revenue. They could use the completed contract method. They have the choice. But for tax purposes, they have to use the percentage of completion method. And then for pension accounting or for other post-retirement benefits, basically with financial reporting, you use the accrual method, right? So you're going to accrue expenses, and there's a very complicated way of figuring out how to do that, particularly if it's a defined benefit pension plan. But for tax purposes, what you're going to do is for a regular pension expense, you can deduct when the contributions are made to the pension fund. And then also for other post-retirement benefits, you can deduct the benefit payments. So that's going to lead to a temporary difference. And then with acquired goodwill, for financial reporting purposes, goodwill is not amortized, right? So you're not going to recognize any kind of amortization expense or anything like that. Now for tax purposes, generally, it's not going to be amortized or get any kind of deduction for acquired goodwill either. However, in certain situations, for example, if there's some kind of asset purchase involved with an acquisition, there are certain situations where you may actually be able to make some deductions for goodwill. Now, with installment sales, installment sales, basically with installment sales for financial reporting, you're going to be recognizing revenue upon shipment of the goods. I mean, that's not a hard and fast rule, but generally speaking, when you've shipped the goods, you can recognize revenue. But for tax purposes, you're only going to be able to recognize revenue when cash is actually received. So if you notice, when you think about a lot of the differences, these temporary differences, they're all timing differences, right? That's the nature of a temporary difference. They're going to reverse over time. But you see with taxes, it tends to more be a cash basis, right? There'll be something to say, hey, look, we're not going to recognize anything until cash changes hands or cash is received and cash is paid out with the warranties and so forth. And with the financial reporting, we're using more accrual basis. And so that's responsible for a lot of these temporary differences between book and taxable income.